Good evening. Welcome to another edition of the ShadowTrader Video Weekly for Sunday, March 15th, 2020. My name is Peter Resnicek from ShadowTrader.net. Major averages are now down, on average, about 25% from the all-time highs. This week has been an incredible rout for the markets. And the question that everybody should be asking right now is, was that it, or could we actually go a bit lower, maybe even to a 50% decline in the markets? I'm going to show you just a couple of nuances that I think will point out that the potential for that at least is there. I'm also going to look obviously at some longer-term charts in those majors, and we'll try to discern where near-term support might be coming up in the near future. Market internals, something that ShadowTrader hangs its hat on very, very seriously. It's really at the core of the ShadowTrader methodology that we teach in our ShadowTrader Squawk Box every day, and I also send out real-time text messages to my options advisory subscribers talking about market internals all the time to get them a better feel for what exactly is happening at the market that moment. And this particular week was really amazing because I saw numbers in the market internals telling us how strong the selling pressure was under the hood that I've never seen before. It was absolutely epic. So I'm going to share a couple of those snapshots with you just to give you an idea of just how strong things were. All right. Last but not least, I'm going to talk a little bit about crude oil today, and I'm wondering if crude oil could actually be, or potentially, not yet, but might be setting up to be the trade of the year for 2020. It's been extremely battered down with all the bad news and poor sentiment, but it's getting to levels that we haven't seen in a very, very long time. So I'm going to look at that chart with you, and then I'm going to tell you exactly how I'm going to play it if we get down to some levels that look attractive to me. All right? Without further ado, let's get into it. So starting with the S&P and going through these majors together, I've marked off how much each index is down from the high to the swing low, which is here. So obviously this is not to the Friday close. This is the distance from here, from the very top to down here. And in the SPX, that is 27% almost from that level. And in the NDX, that is 25.48%. And again, measuring only just from here to the swing low. You can see, obviously, if that's a quarter, this is the half here. We'll get into that in a second. And last but not least, the Russell, which has been beaten up the worst, kind of a risk-off sentiment, is down over 36% from the high. So the question that I'm asking in the video is, could we go further, and is there potential that this market actually could be cut by 50%? Could we actually go down as much as we've gone down already? Tacking it on. And I think the potential for that is there. I'm going to show you a couple of reasons why I think the potential for that is there. First of all, if you look at the SPX, we never really made it to the actual trend line depending on how you draw it. This is more of a secondary trend line that starts here and goes up. I think that the actual trend line is here closer to 2400. I'm a big believer in that when an index or a stock turns around ahead of a trend line, it will usually bounce very lightly and then go through it. Basically what happens is when you get close but no cigar, oftentimes that will be the low. Basically that was the trend line touch. It's like it just didn't go there, right? And different markets show this slightly differently. If you look at ES futures, it actually cracked through the trend line a little bit. S&P made it to the secondary, is almost there. And then if you look at the NASDAQ, this is a classic example of still being so far away from it. And this is another reason why I think there's room to fall, because if you look at the way these trend lines are drawn, all of them are the same in that they all have the same starting point. I call this the main dominant trend line of the market because it is starting from the March 09 lows. So it is really the actual uptrend in the market. And this is actually noteworthy if you think about it, because the NASDAQ could actually be down another 25% and still be in an uptrend, which is really amazing, right? Think about that you still will not have even violated the main uptrend from the October lows. Whereas if you look at the SPX, obviously, a little bit more bearishness is going to break that line, and then the S&P is no longer going to be in an uptrend. It's now going to be in a downtrend. Okay, so continuing onward, we've already established one reason why I believe there is potential for lower, and that is the simple fact that I'm not really sure if the S&P has actually touched the trend line, depending on how you measure it. And the NASDAQ 100 still has quite a ways to go before getting to the dominant trend line, right? We've already seen that. And the Russell has completely obliterated the trend line and is just on its way to Hades. We don't really know what's going on with the rut as far as, it is just obliterated, right? So if you put these things together, technically, it feels to me like the S&P 500 can still have further to go to the downside, even if we aren't taking any of the fundamental factors into play, which is the obvious coronavirus, but more importantly, what are the effects going to be on Q1 and Q2 earnings of 2020? And we're not going to know that for some time. It is only March 13th as I'm speaking to you right now, and the quarter is not going to end for another 2 weeks, and then we won't see any Q1 results until, maybe 10 days or so into April. So it's going to be a little while before we get any numbers, and we should probably expect that those numbers are probably going to be off by a lot given the curtailing of business during this first quarter. So that being said, let's move on to the second point, which is market internals. This screen should be very familiar to those of you that are very familiar with the ShadowTrader methodology and listen to the Squawk Box, watch these videos. Obviously, I talk about this stuff all the time. I'm always sending out real-time text to my options advisory subscribers talking about what's going on with internals at that moment, because this really is the dashboard, if you will. It's just like I always say, you would not drive your car without all those gauges on the dashboard. You need to know how much fuel you have, how fast you're going, oil, etc. This is the same exact thing. So without getting into too deep of a discussion on internals, because we've done that in recent videos, I just wanted to show you the regular internal screen and then some snapshots that I took of a couple different times this week to show you just how strong the selling was compared to more normalized internals. So to put things into perspective, this box here, I should say these two boxes here, is the relationship between the up volume and down volume at the exchange level on the New York Stock Exchange and on the NASDAQ, respectively, the left box and the right box. On an average day in average volatility, let's say if the VIX is bumping around somewhere 13 or so, right? These numbers would read probably like, 2 to 1 positive on a bullish day, or maybe if it's, 2.5 to 1 negative on a bearish day. If things get a little bit more extreme, like you might have a trending day in a low to middle volatility environment, you might get as high as 4, 5, 6, maybe even 8 to 1 positive or negative. As you can see here, I'm recording this on the evening of Friday, March 13th. And we had a very, very bullish rally into the close, a lot of short covering. And you can see that the breadth was 7.5 to 1 positive on the NYSE and 4.45 to 1 positive on the NASDAQ. In a nutshell, that simply means that there was about 7.5 times more volume going into stocks that were moving up, right, as opposed to stocks that were moving down on the New York Stock Exchange. And there was about 4.5 times more volume of the same relationship on the NASDAQ, all right? Got it. Now, next we have a tick here. This is pretty simple. Just shows us where the upticks versus downticks are happening. And on a normal day, you get basically this type of distribution. I call this tick distribution, where you notice that you have about half of these triangles are green and half are red. This is a very simple, stupid methodology that I added onto the quad a few years ago. Very simply just means, where did the 15-minute bars on the tick close? If they closed positive above 0, I give that a green triangle. If they close negative, I give it a red triangle. Usually on an average day, these are pretty mixed up, right? And then I call that the tick distribution. And then here we have a cumulative tick number, which is exactly what you might think it is. It simply adds the ticks happening every time they come in from the exchange. I think it's every 5 or 7 seconds or so, and makes a cumulative number, adds it together, and starts creating a histogram every 15 minutes, okay? So this is basically what the internals would be like on normal, days or so. But check this out. Here I took 2 snapshots of market internals on earlier in the week, I should say. This one was taken on March 11th, and you can see from the time that's elapsed, and down here is 3 p.m. It's around 3 o'clock when I took this picture. Well, look at the breadth here that I circled in the upper left on the New York Stock Exchange, what it was. 60 to 1 negative. It's amazing. This is like these numbers are just off the charts. This tells you that the selling pressure was so heavy and basically, so much volume is going into down stocks. It's 60 times the amount of volume that's going into stocks that are going up. So barely any stocks are going up basically, right? If all the volume is flowing into down stocks. And if we look at the ticks, I just showed you what that distribution usually looks like, kind of mixed up. And usually there's somewhat of a balance. I mean, the tick indicator is kind of like a drunken monkey, and it responds very quickly. And what will happen is you have a lot of stocks trading on an uptick, and boom, it prints positive and it prints negative. It looks like this all day with a lot of activity on both sides of the zero line. But I purposely wanted to take this picture kind of late in a day to show you, look, this is 3 p.m. Eastern. There's only one more hour left to trade. During the entire day, only 2 15-minute bars closed above zero. But more importantly, where is all the activity of the tick? Literally everything is negative. Notice that the blue dotted line is zero, and basically 99% of the activity is all underwater. These are the types of days that when you see this stuff on your gauges, on your dashboard, should give you greater confidence to short rallies. These things, when they're working properly and really showing you the way, are a day trader's dream. And they also help you very, very much for getting in and out of longer term positions to help you time those positions correctly, because you don't want to be going against these indicators, right? So this is March 11th. That's one picture there. And then another picture I wanted to show you is this one, which I took on March 12th, and I took this one early in the morning because you can see only 2 15-minute bars here have formed. So this is at about 10 a.m. Eastern or earlier. And check this out. In the upper left-hand corner, this is amazing. 374 to 1 negative. And guess what? I took this picture too late. It was worse. I was speaking to my colleague Scott Gillum, who runs the Time Spreads Advisory with us, and he said that the number was well over 400. Think about it. The volume flowing into stocks that were going down was 400 times the volume that was flowing into stocks that were going up. Essentially, there were almost no stocks going up, basically. Now, these numbers are very, very extreme, or I should say a little bit more extreme, because they are super early in the day. A lot of times what will happen is this will then balance out a little bit and it won't be as high. But early on, when you have a gap situation and markets trading, lock limit down, etc., all that stuff, you have nicey curbs, kicking in, you have a trading halt. Everybody is just throwing sell orders at the market, and that's what's happening. All right, in the ticks on that day, this one I actually have set to the NASDAQ tick. You'll notice that it's tick Q. I look at both of them. I kind of interchange it all the time. But look at your cumulative tick, how deep it was going down. This is like a minus 8,000 or 9,000 number. It's absolutely amazing. And the same thing here. Notice I was talking about, where are your ticks during the day? You're not even getting anywhere close to the zero line, and you're 30 minutes in, and the high tick is at minus 831, right? So this just shows you how bad things were. And the reason I'm telling you all of this in terms of context, because remember, everything that I speak about is all about context. If there was any one point that I could drive home more than any other, it's that I want to share context with people. I want to always be looking at context. I am trying hard every single day to take my focus further and further away from price and more always on context, because price will always fool you. Price acts irrationally, especially in a high volatility environment like this. Price will often zoom up really high, really fast, and yet these internals in front of you, they won't budge. And people who don't understand this, then they wonder why the ES just went up 50 points and back down 50 points. Okay, it's because that move that was happening in the up 50 points was not really supported by any sort of volume in equities. It's just a futures move going up and down. Obviously, the stocks in the S&P are moving with it, but it's a question of how much volume is happening at that time, right? So interesting to know. So the thing is, when you see internals of this magnitude happening, okay, you can be pretty sure that a longer time frame variety of sellers has finally entered the market. I talk about this a lot in terms of market profile. I'll tell you what type of sellers are in the market. Shorter term scalpers, core traders, swing traders, etc. Right? These are different groups that we look at, all part of market profile theory. Any time frame that is outside of the day time frame is called the other time frame, okay? Or OTF for short. I do believe that the other time frame is active here. Basically, all you need to know about that is that means that if longer term sellers are active in this market, the market certainly can go lower. Because remember, shorter term traders do not really dictate where a market goes or how far. They can dictate it for very short periods, but in the bigger picture where you have larger moves like this 25% decline, this is dictated by larger players, and I'm seeing that as the selling was going on. It was steady. It was a little bit panicky at times, but there were all, mostly earlier in the sessions. But as I was watching very closely, I saw clear signs that there were larger players sitting up on the offer, posting orders out there, and just letting them get hit on any rallies, and really trying to slowly get rid of stock. All right, so keep that in mind. Okay, so also as I alluded to in the intro, I wanted to give you my opinion at least on where are the next potential supports. This is probably the question that most of you are asking, especially those of you that are longer term investors and may still be stuck holding stocks long. The unfortunate answer to that is it's not really that clear right now. This rally has been so long in the tooth that now when you look to the left where the supports should be, they're just kind of not there. But let's look at a couple of levels. In the S&P, if we draw this line directly across, right, we know that this swing low here was 2346.58, so you may want to keep that one in mind. That could mean that there's like, a little bit of an sort of an undercut of the trend line, and then you get some sort of a turn and a bounce. Way to play that would be maybe if we undercut that line, right, and then once you re-enter that line and go back over that low, being that 2346.58, that potentially could be a buy point. That's in the SPX. If we lose that level, then honestly, I think the potential is there, like I said, to go to the 50%, because notice that here, where there's no congestion of price, where price just moves straight up month after month after month, notice these are monthly bars, this is going to offer little support. Maybe a little bit here, at a prior high, just sub 2200, that is potential, right? And then if not, maybe we go to a 50% retracement. And remember, the 50% retracement is really just a Fibonacci number, more or less. It's, it's just something that I'm talking about because the markets did a peak to trough of about 25%, and I'm just wondering, could they double that? And I'm just showing you, yes, the potential is there. And unfortunately, as I was saying, this sort of straight up area here is probably not going to offer that much support on the way back down. Maybe a little bit at the prior high, maybe not. Okay, so that's the SPX right there. Let's take a look at NDX. We'll just go through the three that I watch most closely. NDX obviously has had much relative strength, as I've been saying, and looks a little bit better as far as support. So let's look at some of those numbers. On the bottom here, we went as low as 72.55, obviously with the big bounce on Friday. But we've got this area here, which would be 6,000, and notice what it ties in with. Absolutely perfect on the trend line. So really, to me, NASDAQ 100 best area of support would be around the 6,000 level. Obviously, that trend line is going to move up a bit, and notice that currently it is matched up with this prior low, but it won't be over time. Over time, this line will obviously push out this way, and that trend line support level will come in above the 6,000 level. Okay, Russell has already broken the uptrend, and again, this is the longer term uptrend from 2009 lows, as I talked about. It is now broken. Russell will not find real support until under 1,000, and that's not that far away for it. That's about another 30% down. It's at 13, well, actually 20% down. What am I saying? Because we're here around the 1,200. So just under the 1,000 is the last area where I'm seeing somewhat of a pullback low support, and potentially where small cap stocks could be bouncing. Okay, so now on to the potential trade of the year. With the caveat that in this type of market, with this volatility and so many things running so hard and so fast, down and then up, etc., there's really lots of trades of the year. But this is something that I thought was interesting because there's just a lot of different facets to crude oil that are different from other commodities or even other financial instruments, in the way that crude oil is quite manipulated and can be manipulated by its producers, right? We know that the price is basically beholden to how much supply and demand is on the market, but that supply and demand can be turned on and off at will, right? So right now, what's going on in crude oil, and you can see it's just been absolutely battered. It's trading around $32 or $33 a barrel, is there's a bit of a price war going on between the Russians and Saudi Arabia. And they had recently come to an agreement where everybody was going to cut production together and bring prices back up. But then, for some odd reason, Saudi Arabia actually went in the other direction and actually flooded the market with oil, potentially just to show that they are the big dog in the space. And also don't forget that their product is of a lighter nature than other crude products that come from other parts of the world, and is much easier to extract as well. Their cost is somewhere around $8 to $9 a barrel. So even at these depressed levels, it's fine for them. And they have a lot more cushion, if you can think of it that way, than some of the other countries do. And I think the bigger plan is simply to show, hey, you know, we're the big dog in this space, even though on a purely absolute numbers export amount, right? We know that America is actually the largest exporter, but certainly they are number two, and they just want to show that, you know, show their clout. And more importantly, think about this, they squeeze some players out, and then when they decide they are ready to cut production, they can cut production, and hopefully everybody follows, and you get kind of a price increase to the upside. So that's just kind of the background of what's going on, I think, with crude. And also, everything I just said is also coupled with the fact that crude is technically weak whenever there is a global slowdown, right? This is what obviously is happening right now. There's the fear that this coronavirus pandemic is going to destroy economies worldwide. Crude doesn't like that, so obviously it's pushing lower. So that being said, crude is pushing now to levels that we have not seen in a very, very long time, okay? The swing low here, and I marked it off, was 26.05 a barrel, and that was just inside, that was just at the start of 2016, right in here, okay? We went as low as 27.34 a barrel on this last swing very, very recently, okay? So this is noteworthy, I think, that we have come so close to this and bounced. This is very similar to what I was saying about stock index futures or stocks or whatever. Remember, I said this earlier in the video, and it's a very, very good pro tip, if I can call it that. When you get a bounce near an inflection point, okay, like this one, right? It came close but no cigar. It was near it. Always assume that was it. That was the bounce. Don't be a buyer of crude with limit orders at 26.10 or 26.15 thinking you're going to be smart and get it at this swing low, okay? This was the swing low. That was it. It just wasn't exact. Remember, support and resistance doesn't always have to be an exact science to the penny. It often can be, which is fascinating and fun when you've got orders stacked, just above those levels and you get filled. I talk about that a lot in day trading. On intraday charts, that's actually very, very possible. It's very easy to put orders up against certain levels, especially horizontal lines, and get filled and get the rollback or the bounce, and there's your day trade. But on longer term charts, okay, when sometimes you go close and you don't get there, remember, that was it. So for that reason, I think that crude is actually going to have some sort of dead cat bounce and revisit this area and go through. Now, if it goes through, understand that crude has not been sub 26 since late 2001. This is absolutely amazing. So these are prices of 19 years ago. Think about that for a second. 19 years ago. This is crazy, right? And there's not that much inflation out there, but obviously there is, some measure of inflation. So basically, the bounce will come. There's no doubt about that. Obviously, the globe, unfortunate as it may be, is certainly nowhere near ready to have energy independence away from this product. That's absolutely not happening anytime soon. We are doing our best. We're ramping up, but certainly, we're not going completely energy independent. So my point is, I don't think these prices last at these levels very long. I think that crude is a buy, probably in this area. I would set an alert on any break below the $26 a barrel level. So you have your alert set in here, and then look to be a buyer inside. If we went all the way to the 2001 lows, which would be pretty amazing. That would be 1712 a barrel, I believe, if I can read it over the candlesticks where I've marked it, right? That, of course, would be an even more amazing buy. If we drilled actually through that on some sort of spike move, even more. I believe these moves will potentially be very short-lived at these levels. It would be really have to be like a serious global full-on slowdown, like the recession to end all recessions, I think, to keep crude at these lower levels. Remember that there are certain price points for all producers where they make or lose money, and that is important. So you'll have, by nature, more players simply getting out of the game, right? If they can't afford to produce at those levels. If it comes down to, only Saudi Arabia and America, I'm not that well versed in the space, but the simple economics and supply and demand apply, right? When players get squeezed out of a space, that actually limits the amount of supply that comes on the market, and lo and behold, prices should go higher. So how am I going to play this? Well, there's a lot of different ways. The most bang for your buck is going to be in this product here, which is the CL. And in /CL in crude contracts, you'll notice that currently they are listed out to August 20th. I would be interested in probably picking up some crude contracts, probably in this range with the 100 days out to June or July. So maybe either the 66 days out, the M20s, or the N20s, right? The crude is currently in a state called Contango, which is as it should be. Contango is very simply when longer dated contracts cost a little bit more than shorter dated contracts. That's the sort of the normal way of things. The opposite of that is a state called backwardation. Backwardation is when this whole thing is flipped, and it's actually cheaper to get the ones that are out long than the ones that are up close. That's not the case right now. There is a little bit of erosion of price, right, as these get closer and closer to current time. But notice that the spread between them is actually not bad. These current front month prices, with only 6 days to expiry, are about $32.93. So let's call that 33. You'd be paying up about $1.28. And remember that $1.28, that sort of spread of it, that piece is going to eke out little by little as time goes on. So I don't think there's that much real danger here of losing a lot of money on that. And I would go with these longer contracts only because I would avoid the pain in the butt of rolling, right? Rolling is simply where you would sell the contract that's expiring and buy a further out contract in order to prolong your position, obviously, right? Because you haven't hit your target yet or whatever, you still want to be in it, okay? But that also is slightly more complicated in the fact that, remember, you would be taking profits on the first position, and then you would be reestablishing a new position at a higher level. Me personally, that's not as attractive, but it doesn't really matter. It's not any different mathematically. So I would probably be looking at these crude contracts further out. That's one way to look at it. Now, the thing you have to understand with crude contracts, if you've never traded them, and I've only traded them a few times in my lifetime, I'm really not any sort of a regular crude trader, is the fact that they are extremely leveraged, okay? Extremely leveraged. So if you look here, look at the active trader of, the futures trader, I apologize. And I've put this into CL here. And I want you to pay attention to this. This is what's important, okay? So CL trades in 1 penny increments. You can see here, quantity, tick, minimum 1 penny, correct? Currently 32.27 by 33.50, all right? You'll need $7,700 currently in your account to trade just one contract. That's not really the important part. The important part is this part here, is the other part to understand how leveraged this is. Okay, if it's $10 for a penny, do the math. It means it's $1,000 for a full dollar, right? Think about that. 10 cents would be $100, and 10 times that is 1,000. So as crude moves up and down on the chart, if you hold just one contract, it's $1,000 a point. So if you buy that contract, let's say at 26, and crude falls further and goes down to 22, that one contract is going to be down $4,000, all right? So the trick is basically to accumulate the contracts somewhere in here or wherever you think it's a low and hold on for dear life, but at the same time, be careful enough to not be involved in something that you cannot, basically afford to lose, right? Don't be piling into these things and not understanding just how leveraged they are, okay? All right, for a little bit calmer trade or easier to manage trade, there are ETFs. And there's a number of ETFs on crude, and a lot of them are 2 times, 3 times leveraged ETFs. And I don't think those are a good idea for longer term traders, because remember, they are juiced up by futures contracts, and those futures contracts have that rolling cost, which I just showed you, right? When I showed you that spread here between the longer and the shorter, well, think about it. They hold the shorter, and then in order to juice up the price a bit, it's not just crude oil itself. They have futures contracts. They need to sell the closer dated ones and buy the more expensive ones, right? Which causes a constant erosion of value in these 2 times, 3 times leveraged ETFs. So I wouldn't mess with those. Instead, what I would be looking at are the simple one-time ETFs. And I'm going to show you 3 basically that are the ones to play. USO, which is the United States Oil Fund. You can see here has been pretty battered down a bit, kind of moving with crude, obviously. Now, this one only has in its portfolio 1 month contracts, and then it's important to note. And that's why I actually do, even though USO is the one that everybody knows, trades a lot of volume, I don't think USO is the vehicle for a longer term trade. Okay, it only has short term crude contracts in it. Ones that are longer are DBO, which I believe is 6 months. You can see here, right? It's dropped down from 11 down to 6.5, right? This would be pretty good to use DBO. And then the last one is one called USL, Uniform Sierra Lima. This is a 12 month. So this has longer term futures contracts in it. All right. And these are all just one time. These are not leveraged. So you shouldn't get that sort of erosion. All right. So these are ones that I would be looking at potentially. I think DBO or USL would probably be the better buy. Now, you might also be thinking, what about options, right? Couldn't I just buy options on these? And remember, you can also buy options on crude. That's really not for the faint of heart, because that's really leveraged, right? We've already talked about how leveraged crude futures are. There is also options on options on the futures, but I'm not going to talk about that. But there are also options on these ETFs. The problem with them is that if you look at, for instance, DBO and USL, which were the ones that I was saying, there's not a lot of volume or open interest. Look at the volume and open interest. It's almost nothing, really. So, these are huge spreads. You're probably not going to be able to pick this up for any decent price. Looking at USL, you see the same thing. But USO, on the other hand, does have a very robust options market. So that is one to consider. You could go further out and pick something up like way out here, probably 125 days out. And you can see that even in these longer dated contracts, right, there is huge open interest. There's huge interest in these, where there's a lot of trading in these, people buying these further out, speculating on the price of oil, hedging their futures contracts, whatever the case. Oil is obviously a very, very popular market. So keep that in mind. I think that for holding stock, DBO and USL are potentially the best bets. USO maybe, without USO maybe not so good because it's a 1 month, but does have the more robust options market.
And that's all for this week. Thank you, as always, for spending just a little bit of your weekend with me. When volatility gets as elevated as it is currently, there's huge opportunity in the market, especially on a short-term basis for traders that are experienced. But this volatility cuts both ways, and traders that are not as experienced can really get hurt in this environment. This particular week, I've probably received more emails regarding my options advisory than I ever have since we started those advisories. And basically just from people saying thank you for keeping me on the right side of the market at all times, and pointing out all those little nuances that can help me to make more money. One of these was really interesting to me, and if I could just take a tiny bit more of your time, I wanted to share it with you. This gentleman named Adil wrote me this week, and what he says in the beginning of the email really grabbed me, because obviously this is against the backdrop of such a horribly bearish week. He says, "This past week has been the best trading week of my life, particularly today. The voice notes that you send out, along with small insights that you see during the day, has kept me confident and short in this market. Even with my bad trade location yesterday, once you confirmed that you thought it was going lower, it gave me confidence to keep all my short positions on. Thank you, Peter, for all the lessons. Adil." Adil, congratulations on the best trading week of your life. Nothing makes me happier than when my subscribers profit along with me. If you'd like to join me, check out the link below, shadowtrader.net/ options. It's extremely reasonable, $49 a month. I purposely always price all of these advisories very, very reasonably because I know what it's like to be just starting out in this business. And when you're just starting out and trying to find your footing, figure out your strategy and kind of work through everything and figure out how this game works, you don't need to be paying hundreds of dollars a month for trade ideas and guidance. So I try to keep it as reasonable as possible. No contract ever. You can sign up, cancel anytime. Remember, it also includes a free subscription to my Peter's Pre-Market Perspective, which is my 9 a.m. Eastern sharp morning report describing what's going on in the ES futures through the lens of market profile. All right. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.